Hey, I'm Ben from Modern Graham, and today we are going to do a Modern Graham analysis of US Bancorp. So let's go ahead and get started with that. So here we have the basic overview. We have the company. This is in the financial services, of course, and it is a bank. Current price is about $42.12. And here are the important things from the balance sheet that I view. Current assets, current liabilities, long-term debt, total assets, intangible assets, total liabilities, and shares outstanding. All of those things will play a factor in the rest of the analysis. Now, looking at earnings, we can see that like many banks, we saw a rise in earnings. Let me fix the formatting here real quick. And it rose up until the financial crisis hit in 07, 08. And then we had a big drop in earnings, and since then it has been recovering pretty well. We had another drop in 2020 related to the pandemic, and another drop is anticipated in the estimated earnings per share. Over here we have the earnings per share Modern Graham. This is a normalized earnings figure that I calculate. It is based on the past 5 years of earnings with the most weight given to the current years. So for the current fiscal year, the estimate is $4.19, which is just a little bit above the estimate for not weighted. But you can see that overall that has been on the rise for the most part for a long time here, again, since the beginning of the financial crisis. Here you can see on the graph just a different visual display of how those earnings have been growing. And then we also have dividends here, which have followed a very similar setup. Had a huge drop at the beginning of the financial crisis, and then it has recovered quite a bit. You can see that in red here as well. Dividend payout ratio, that has been pretty steady at about 30 to 50% of their earnings. So that you kind of would expect. They're actually a little bit lower than a lot of other companies I've been seeing lately, which are in the 40 to 50% payout rate. And so they might have capacity to continue to rise the dividends, or they might be well set up to absorb a drop in earnings and still keep that dividend steady. Stage 1 in the Modern Graham analysis is to determine if the company is suitable for the defensive or enterprising investor. A defensive investor is somebody who does not have the time to do a ton of research into an individual company, so they have much higher, stricter requirements before they will even look at a company. The defensive investor requires a company pass SIPs out of the following tests. First, we have the size of the company. It has to be over $2 billion. It passes this one. It has to have a current ratio greater than 2. It passes this with a current ratio of 5.94. Earnings stability have to be positive for at least 10 years, and we pass that as well. Dividend payments have to be present for over 10 years. We pass that. Earnings growth, we have to grow by at least a third over the last 10 years, and we have just barely achieved that for this one. So it passes that. And the price to earnings Modern Graham ratio, that is the price over the earnings per share Modern Graham, that comes to 10.02. That is less than 20, so it passes that requirement. Price to assets, the price to book is below 2.5, so we pass that. And the PB times the PEMG is below the 50 threshold for that too. So this one actually gets all 7 points for the defensive investor. Enterprising investor, by default, it is suitable for the enterprising investor. We already know that because it is suitable for defensive investors, but we'll go through the test anyway, just in case. The current ratio is greater than 1.5, pass. Debt to net current assets is below 1.1, so we pass that. Positive earnings per share for 5 years, we pass that. Currently pays a dividend, we pass that. And earnings per share have grown over the last 5 years, so we pass that. We get a perfect score for the enterprising investor as well. Look at that. Pretty cool. Now, moving on. Stage 2, determination of intrinsic value. So for this, we look at the Modern Graham value formula, which is derived from Benjamin Graham's book, The Intelligent Investor. And that is value equals earnings per share times 8.5 plus 2 times the growth rate. I use my earnings per share modern gram, the weighted average for earnings, to continue to smooth that business cycle out a little bit. But the two factors that we have to calculate, the variables, are earnings and growth. So looking at earnings, again, we take a look at all of the earnings, but we really care most about the last 5, and that gives us the average of 4.19. Total growth, we look at the current earnings per share. 5 years ago, it was $3.59. We've seen 16.67% growth in those 5 years. Divided by 5, that is 3.33% per year. We have a safety margin built in here because this is a hugely important variable in this formula. Any change in that growth rate can have a big impact on the value that comes out of this. So we want to make sure that we are being extra cautious here, and we lower that safety margin a little bit. And so the growth estimate is only 2.5%. Plugging in those figures, we get a value of 50 cents, and that is greater than the current price of $41.99 over here. And so it is undervalued, just below my threshold. So to give something an undervalued rating, I require it to be at or below 75% of its intrinsic value. That is the case here, so it is undervalued. Other important factors that we can consider: net current asset value, we'll talk about that in a moment. The value based on 3% growth. If you assume that this company will grow at 3% in perpetuity, that's the value that you would have right now. If you assume that it will grow at 0%, then in perpetuity, if it will not grow at all, this is the way it will be forever, the earnings, that is the value it should be at. And then if we solve for the growth rate using the current market price in our value formula, then we find that the market is implying a growth rate of 0.76%. So if you think the company will grow more than that, then it's one way to view this as that would be an undervalued company. And if the market rate is below what you think it will be, then it's undervalued. Now down here we have the modern gram grade, and we're going to give different points for different factors. Investor suitability, it is a defensive investor stock, so it gets 2 points there. It is undervalued, so it gets another point. It is trading below the gram number, so it gets another point. We'll talk about gram number in a minute. The long-term dividend growth, it has not grown its dividend for over 20 years, so it does not get points for that. The yield is above 2%, so it gets half a point for that. The PEMG is below its industry average, so it gets half a point for that. And it is not trading below its net current asset value, so it gets no points there. But overall, it gets 5 total points for a grade of A. Here you can see how I divide out the different grades. And just a quick little graph here. The current price is here. The value is higher. Stage 3, further research. So it is important at this point to consider. We know that it's an undervalued company, but you need to look at your own portfolio and determine if you think that this company is worthwhile for you individually. Some things you can consider are the net current asset value formula, which is really a liquidation value. It is trading way above its liquidation value because that is negative, so that doesn't apply so much here. Gram number formula. The gram number is another way of looking at some of Benjamin Graham's requirements for investors, and this kind of calculates it into a number so you can easily compare different things and see, okay, well, this one is a good one. Some people like to use this. The gram number for US Bank Corp is 5131, so it is trading below that number and may be a good opportunity. PEMG formula, like I've said, the price to earnings ratio here with the weighted earnings is 10.02, so that can be useful when comparing to other opportunities as well. The current ratio is 5.94. Price to book ratio is 1.49. Dividend yield is 4.41%. That is a pretty good dividend, and it has grown for 12 straight years. And like I said earlier, the dividend payout rate is relatively low. And so it would seem like they might have the capacity that even if earnings drop over the next couple of years, they still might be able to continue growing that dividend. So that 4.41% is pretty attractive, I think. Okay, so stage 4, if you have gotten this far and you've decided that the company is suitable for your investor type and it's undervalued and it would fit in your own portfolio, then the next step is to look at the chart and determine when a good buying opportunity is. Because we want to try to maximize the amount of profit that we are able to make from the company. And looking at the chart here, there's a couple of things to note. We're looking at the daily chart right now, and starting in January of this year, which is common for a lot of companies we've been looking at lately, we see a downward trend. And that is coming down. It has this trend line that it has. I mean, this is where it got established here, or it kind of here actually. And then it came up, it hit that, it came back down, came up. It tried to break above that, and it did for a while, but then it came back down. It tried again, but then it fell back through. On the other side, it has come down and bounced off of about the same trend line. So it's kind of a dangerous spot here. Now here, what has happened is if we go all the way back here to 2020, there's a gap here, and it jumped up, and then it didn't fill that. So now we call this filling the gap. The market has come in, it has come back to fill that gap in the trading chart, and that has been filled in, and now it's trying to come back up to this trend line. And it'll be interesting to see what happens if it crosses that again. It looks like today, as of recording, it is coming back down, which would indicate that it might have more downward falling to take place, in which case we'd really want to look for around here would be probably another point. This one I will mark as red, because if it falls below that, it's even worse. If it comes back up, it will be good. If it can break through this trend line and then break through this level here, it would be a really good sign. And then even longer term, if it were to pass through that, it would be in a good spot. Again, that would be a very strong support level once it gets above that. But yeah, right now, I would really be watching to see what happens, whether it continues to follow this trend line or break above it. And eventually, if it comes all the way down here to 34, I would really be watching it there to see if it can stay above that and then hopefully break above and then be back on an upward trend again. So those are the things I'd really be watching on that, and you could watch that as well. So now this company was one of 10 in my high yield defensive stock list that I posted recently. You should watch that video and see the others. It is on the screen now. Be sure to click on it and watch it. Thanks for watching, and I will catch you next time. Take care.